Welcome to This Week in Money. I'm Phil Mackesy. Today, Jack Crooks on the fate of the euro, Gordon Chang on what's next for China, and David Skarika wraps up the week in markets. We begin with Jack Crooks right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Jack Crooks is president of Black Swan Capital. He's a currency trader and investment advisor. He publishes Black Swan Currency Currents, a free global macro and market newsletter. And you can find him online at blackswantrading.com. He's with us today from Palm City, Florida. Jack, it's good to have you back on This Week in Money.
Thanks for having me, Phil. Happy to be here.
It's a crazy week in the markets. They've had their hands full this week. Slowdowns in the U.S. and China and the Eurozone debt crisis. This thing has been going on for a while. It just won't go away. Let's start with the euro and talk about what's going on here. It's off a 4-month low against the dollar, down to $1.26, not far from its lowest of the year. This morning it's back up to $1.27, but we are not out of the woods with the euro by a long way. And the problem, of course, in one word, is Greece.
Yeah, it's Greece. Is the trigger now. It's the catalyst. But even beyond Greece, some people had thought, well, they could sustain Greece and develop these so-called firewalls. But the reality is the exposure to Greece is very massive across the zone financially. And even beyond that, you have the potential for speculative attacks on the bond markets in general of the periphery countries. So it just adds to the pressure. So Greece is definitely the catalyst here, thanks to the election. They're pretty much repudiating the deals that Greece signed before. They just can't handle this austerity on the people in Greece, and this type of mentality is spreading across the Eurozone.
Jack, this is not something that just sprang out of nowhere. Walk us through how this happened. How did we get to this point with Greece?
Sure. The reality was Greece should not have been in the zone to begin with. They never met the Maastricht criteria and other treaty criteria, but there was some little manipulation with the help from our friends from Goldman Sachs, as usual. Their fingerprints tend to be everywhere.
Yeah.
But given that, Greece economy really is not something that's going to come close to competing with the powerhouse in Europe, and they were the weakest of the many weak sisters inside the Eurozone. And I'm speaking of Germany as the powerhouse.
Okay.
The unfortunate thing is that the structure of the Eurozone is set up such that because there's a single currency, a single fixed currency, the euro, these various countries have to compete against Germany, and to do that, they have to really hike up the efficiency of their markets, of their labor markets, of their manufacturing processes, and those that aren't able to do that get more and more pressure upon them. And Greece is the first one to finally crack under this, and there are others that are following exactly down the path of Greece. So that's the basic problem: is the straitjacket of the euro itself.
Jack, a lot of folks worried that the doomsday scenario here, Greece leaving the Eurozone, is that really a bad thing for world markets?
Well, I think it is, just because of the financial exposure. And I do think that if Greece goes, the next, people will then attack the Portuguese bond market, which is already in trouble and rising, because Portugal's really traveling, as I said, down the same path as Greece. They're just a little bit further behind. Their economy is cratering. They're going to need another another bailout. It's the same situation. The austerity measures are crushing their economy. There's been no real competitiveness changes in these economies. So that's the danger. The speculative attacks just add to the problem of Greece. If it were Greece alone and Greece were isolated, no, and it potentially would be positive for the Eurozone to get Greece out of there. But just the intertwined relationships of the whole system, because it is a system, is what creates the problem.
We've been watching the Eurozone thing crater for a while here. Last week, Greeks withdrew almost $1 billion from their banks, and today we're hearing from Spain that shares of Bankia, Spain's fourth largest bank, sinking 27%. Customers have withdrawn more than $1.25 billion, and Spain, I guess, would probably be the next domino, wouldn't you think?
Yeah, Spain is in real trouble, and the reason that's such a problem for the Eurozone is Spain is such a large economy relative to Greece. And once again, we have a situation where the particular austerity measures being imposed are just cratering the economy. Unemployment is soaring. So you not only have rising unemployment, rising social unrest, you also have finally the banking crisis that was kind of simmering underneath the surface for many years in Spain is finally coming to the fore. And the really related problem becomes that if you look at the bond markets in Spain and Italy, they move very much together. So an attack on Spanish bonds is going to be an attack on Italian bonds, meaning they're going to push the interest rates up dramatically in both of these markets. And the net exposure between those two countries is estimated between $3 and $4 trillion of financial exposure just in those two countries, much bigger than any firewalls, by far. That are available to save that. So there's the concern that Spain creates. It creates an Italy problem.
We're talking to Jack Crooks here on This Week in Money. All eyes, of course, have to be on the 800-pound gorilla, and that, surprisingly, is the U.S. dollar. It's doing great. It's the reserve currency of the world, and people are heading towards it like never before.
Yeah, it is kind of funny. I mean, with the U.S., with all its warts and problems and debt problems, just by virtue of the fact that it is the deepest, they have the deepest capital markets in the world, people have to move money into safe places. And obviously they're exiting the Eurozone, which is the next largest bond market, in general. So they got to come in and hide in the treasury markets in the U.S. And when they do that, the U.S. dollar, tends to rally. Mm-hmm. There's also other odd things going on out there, dollar supply funding out there. The Eurozone central banks the Eurozone banking system is deleveraging and just reducing their dollar lending out there. So you have all kinds of weird stuff happening that are generally beneficial to the dollar in here. And it should continue to carry if we continue to see this play out, and we believe it will. So we think the dollar can go actually a lot higher from here.
What's next for the dollar? Some folks in the press calling for a massive breakout in the U.S. dollar. Do you think that's realistic?
Yeah, I do. I think the dollar index really has room to run because of the reasons we just talked about. And if you add in the background concern that we haven't talked about, which is also part and parcel to the pressure on Greece, is the falling demand from China. Mm-hmm. Germany ships a lot of stuff to China. There's a very symbiotic relationship between Germany and China demand from the Eurozone itself. So as that slows down in the background, you're seeing the emerging markets getting currencies being hit very hard. You're seeing the commodity currencies, particularly New Zealand and Australia, hit. So generally, the dollar's reflecting that flow, a little bit of speculative money coming out of the Asian bloc area. So it's getting a flow from there and a flow from Europe itself.
Let's talk about some of these currencies, specifically the yen. It is up at a 3-month high against the dollar and the euro. What's going on in Japan?
Yeah, I'll tell you, I'm not sure what to say about the yen. We thought the yen was at a position where it finally was going to break out in a big way and weaken in a big way, and it soared yesterday on better than expected performance from the Japanese economy, and the fact that Bank of Japan said that they're not going to ease or on hold again. So the yen is just acting very, very well in global risk as it used to, and so it's doing that in spades again. A little bit surprising in here. If this trend move in the yen continues, mm-hmm. given what's going on in the global macro environment, who knows, the yen could break down and even test its old lows in dollar yen, i.e. the highs in yen against the dollar. So it's a very, very odd situation, what's going on in the yen. It's a tough one.
Let's talk about the resource currencies, the Aussie dollar, the New Zealand dollar, and the Canadian dollar. What do you see happening here?
Yeah, I mean, the Aussie is just getting spanked very, very hard, and it's because of that. We think it's because of that Chinese risk premium in there. You know, Australia is so highly dependent on what goes on in China, and China's economy has decelerated fairly rapidly in here, and there's still signs that there could be a hard landing. So you're seeing that risk premium come out of Aussie very, very fast. Okay. New Zealand, ditto. They're just falling like stones in here. Canadian dollar's getting hit, but on a relative basis, holding up fairly well against the other commodity currencies. Generally because its financial system, the banking system, is still in great shape, as we're told. Whether or not that's true or not, we'll see. But also have some modicum of demand tied to the U.S., where if demand is falling in China and the premium is so bid up high in the Australian dollar, on a relative basis, it's going to tend to get hurt against the U.S. dollar and the Canadian dollar. So of the commodity currencies, Canada, we think, is the strongest of the lot. But if this game continues in terms of global growth being etched down, we think Canada is going to fall against the U.S. dollar also.
What about the Asian currencies? Reading this morning that they're headed for the biggest weekly drop since November. Got to be hurting over there.
Oh, yeah, and that, again, is a reflection of the slowdown going on in China, but also it's a reflection of what's going on in the European banking system. People don't realize that the European banking system is the largest supplier of finance credit throughout Asia. And as the European banking system pulls in their horns and they deleverage, it pressures the emerging market currencies from a credit standpoint. So we're starting to see kind of a double whammy play out there for the emerging market currencies to the downside.
We're talking to Jack Crooks from Black Swan Currency Currents here on This Week in Money. Let's talk about real money for a second here, gold, and the effect on gold of what's been happening out here. What do you see from where you sit?
Yeah, one of the interesting things is, gold's taking a pretty good hit. It's worked up well in the last couple of days. One of the things that we've seen in gold is when portfolios are hit hard, when stocks come off really fast, there's a lot of gold selling going on, really, to pay margin calls effectively, using gold as as a store of cash, so to speak, to go to. And we see that the last time we saw the major problems in 2008 in the credit crunch, we saw the IMF sell off a bunch of gold in order to create credit, for emergency loans and things. So in a real crisis situation where liquidity is needed, gold is acting as a liquidity asset, as a store to move, to turn into liquidity, and it tends to pressure gold lower, and it tends to lose some of that safe haven aspects of gold. Now, ultimately, if there's an attack on the bond markets in Europe, across the bond markets, and it looks like there's going to be a speculative attack on one of the other major bond markets at some point, maybe Japan, then people would have to think that gold would be a place to be. So although near term we think it's fall on this liquidity move, longer term view, we think ultimately it's going to come back.
Jack, what do you say to people who are predicting the end of the greenback as a reserve currency? Certainly, based on this week, it's not going to happen.
Yeah, and we've talked about this a bit, and as I do. Unfortunately, there's really no alternative, and it's pretty scary when you see the way the U.S. government has treated the U.S. dollar as basically toilet paper, and yet people are running to the dollar in times of concern. It says a lot about how bad the other economies are out there, and just how the U.S. as a funding asset globally. Ultimately, I think a new monetary system will have to take shape, but that could be years and years away. It's just not something that happens overnight. The Chinese currency, a lot of people point to, it could be 20 years before we get to some real challenge from the Chinese currency. And in the interim, who knows? Maybe the governments can get together and do something. But that's a tough process. And as you know, we watch these governments get together during these G20 summits. They can't even agree on the headline for for the summit, the PR piece, let alone a monetary system. So I think it's a long way off, unfortunately, and we're probably going to have to suffer through with the imbalances and different problems created with the dollar as a world reserve currency.
What about QE3, Jack? You think we're going to see that this summer?
I wonder. Since everybody recently was saying it's a done deal, I wonder if it's not going to happen at all. And the reason I say that is, I think Bernanke a little bit showed his hand by saying to the U.S. government that, I've basically done what I can. If you guys don't get your fiscal house in order, there's nothing more we can do. This whole fiscal cliff thing that it's now been popularized in the U.S. So I'm wondering if Bernanke has reached the point at which he realizes that monetary policy at this stage in the cycle, what good is it? It's not a banking liquidity problem in the U.S. in terms of QE3. They've got plenty of money. It's a real economy problem, and the idea of forcing more and more money into the U.S. financial system hasn't worked in terms of getting that money into the real economy. Do they do it to try and pop up U.S. financial assets again? Maybe, if they're that, they may be that desperate, but to us, it's just we're very neutral on it. We can see, we're not sure, I should say, but we never can underestimate the Fed doing the wrong thing at the right time. So we'll have to watch and see.
Jack Crooks is president of Black Swan Capital. He publishes Black Swan Currency Currents, and you can find him online at blackswantrading.com. Jack, always a pleasure. Thank you, sir.
My pleasure, Phil. Thanks for having me.
Coming up, Gordon Chang on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Gordon Chang lived and worked in China and Hong Kong for almost 2 decades. He's a columnist at Forbes.com and TheDaily.com, and he blogs at worldaffairsjournal.org. Just click on the blogs tab for Around Asia. And you can follow him on Twitter at Gordon G. Chang. Gordon, it's nice to meet you, and welcome to This Week in Money.
Thank you very much.
You were a keynote speaker, Gordon, at the New York Hard Assets Investment Conference this week, talking about China. The economy is failing, and it's becoming politically unstable. Let's talk about the economy first with some of the numbers you talked about in your Forbes column, starting with trade.
The most important thing here is that imports increased only by 0.3% in April, when experts were thinking that it would increase by 11%. And that anemic 0.3% number essentially says that there's weak consumer demand in China as well as weak manufacturing. And that really pointed out a number of things that have really been troubling analysts in the last couple months. What we are seeing are signs that the underlying Chinese economy is really starting to head towards 0% growth. Most important is that the output of electricity increased by only 0.7% in April. And because the growth of electricity usually outpaces the growth of the underlying economy, we're talking about a zero-growth economy.
Okay, we've expected the Chinese economy to kind of power the world for the last little while, or so it would seem. Now that things are returning to normal, what next?
Well, I think what next is we're going to see a very long period in China of low growth or no growth. It's very much like what we saw in Japan after its bubble. Okay. The Chinese are reacting the same way that the Japanese did, and so we probably will end up with pretty much the same type of performance, which is really quite unimpressive. The problem is that what really created the Chinese boom of the last 3 decades really either no longer exists or are disappearing fast. So, for instance, China is no longer reforming. The international system is no longer benign, so therefore the countries are not accepting Chinese goods like they were in the past. And also China's demographic dividend has turned into a demographic bust. Mm-hmm. And that is going to be perhaps the most important reason why the Chinese economy has just about reached the end of the road.
Gordon, let's talk about the implications for the resource economies like Canada and Australia, because that's where we are here in Canada. Are going to be the first to feel the effects of this Chinese slowdown?
Well, outside of China, they probably will be. Australia is already noticing that its exports of iron ore and coal are starting to decrease. And Canada, if they're counting on help from China, probably not going to get it. And I think part of it is because China in the past has stocked up on commodities like iron ore, crude oil, and the rest of it, and they probably have too much of it considering what's happening in their underlying economy, which means that China has already started to decrease its purchases of key commodities, and it very well may start dumping on global markets those commodities it has already stockpiled.
Let's talk about the banking sector in China. It is also under pressure. Here's news here in April. Deposits falling by, see if I've got this right here, $75 billion.
No, by a lot more than that.
Okay.
Essentially, what we saw is household deposits decreased by more than $100 billion. Net overall, maybe $500 billion decrease in deposits because the government has been putting some money in the banks. This is a really worrying sign when China's households take their money out of the Chinese banking system. Because Chinese banks, although they are insolvent from a balance sheet point of view because of all the bad loans and questionable loans they're carrying on their books, they nonetheless are very liquid. And so they can continue this situation for a very long time. But once you start taking liquidity out of the Chinese banks, it means then that they have to then start facing up to their problems. And that's going to be very painful.
We're talking to Gordon Chang on This Week in Money. News here from the World Gold Council. Chinese gold demand hit a record high in the first quarter, and this sounds innocent enough, doesn't it, Gordon? Demand may surge as much as 30% this year as rising incomes boost consumption, making China the world's largest bullion market. That sounds very innocent, but way back in January, you wrote in your piece on Forbes, why are the Chinese buying record quantities of gold? It is not the People's Bank of China that's buying all the gold. Who is it?
I think most of the gold demand is really coming from Chinese citizens because, first of all, they started using it as an inflation hedge, but they started buying more and more gold as inflation eased, and so there's got to be another explanation. And I think that they basically are using gold as a means of capital flight.
Okay.
Many Chinese can't export cash abroad, so what they're doing is the next best thing, which is buying gold. And that gives them a refuge not only from plunging property prices and declining stock market values, but also as a protection against a possible depreciation of the renminbi. And so essentially what this does is it gives them, the nervous in China, a way of protecting themselves.
Is that bullish for gold?
I think it's very bullish for gold because, as everybody says, China is on track this year to become the world's largest importer of gold, passing India. And the government also has some reasons to buy gold as well because they may be using it as a means of avoiding U.S. financial sanctions on Iran. And maybe they're trying to dress up the renminbi a little bit by trying to convince people that it's backed by the precious metal. So essentially what we have is a country that is buying gold. But I think primarily the main impetus for gold purchases is coming from the citizens, not the government.
We're talking to Gordon Chang on This Week in Money. A quote here from our friend Mike Shedlock. I'd like to get your take on this, Gordon. Mish says, China bulls in for a multi-year shock. Rebalancing from an economy overly dependent on exports is going to be far more painful and last much longer than most think. What do you think?
Yes, I think that China is in for decades of stagnation because now it's in a super cycle downwards, which means that leaders will no longer be propelled by trends. Going forward, they're going to have to succeed in spite of them, which means that they're acting in an adverse context. The Chinese economy is ill-prepared for the current global situation. We saw that because China's problems really started to manifest themselves in September and October when European purchasers stopped buying goods in the same quantities that they had in the past. So Europe has really affected China, and that has exposed a lot of problems in the Chinese economy. It is just not really prepared to deal with the world as we are now seeing it.
Gordon, let's talk about the dragon in the room, I guess we could call it, the political situation in China. Way back in 2001, 10 years plus ago, when you wrote The Coming Collapse in China, you said the Communist Party in China stands in the way of meaningful political change. It cannot meet the challenge of a dynamic society. You said communism would collapse. And let's fast forward to today. That's pretty much what's happening over there, right?
Yeah, in 2001, I said it would take about a decade, so I'm about a year off. But what we're seeing is the Communist Party is suffering from very severe infighting. Maybe it's even fracturing. This is occurring while the economy is stumbling, as we just talked about. The authority of the central government is eroding. The military is breaking free of civilian control. And Chinese people are taking to the street. So you have a country which is in distress. And this is not to say that the people at the top of the Communist Party won't be able to settle things, but it's increasingly looking like they won't, because day by day we're seeing a dynamic that is increasingly difficult to reverse.
We're going to see a change of power from Hu Jintao to the new guy, Xi Jinping. According to Wikipedia, he's 59. He's currently vice president, known for tough stance on corruption, and he's open to political and market economy reforms. What do you know about this guy, and what can we expect from him?
I don't know what we can expect from him, and I think the Wikipedia description's a little bit optimistic.
Sure.
Every time there's a new leader in China, there's a lot of optimism in the West about how he will react. The one thing that's very important to understand is that it's not important what Chinese leaders think. It's important to understand the context in which they act. And any new leader of China, even in the best of circumstances, takes about 2 years to consolidate his position within the regime, which means that basically in those 2 years, not very much gets done. So even if Xi Jinping were a reformer, and maybe he's not, but even if he were a reformer, it's going to take him a couple years to sort of be able to consolidate his position, which means that not very much is going to get done.
Okay.
And what is critical now is that things need to get done. So you're basically seeing paralysis in the Chinese government, and we have noticed this especially in the economy, as Chinese leaders have done very, very little while their economy has slid.
I guess the larger question here, Gordon, is the one-party system still appropriate for China, and what could you replace it with?
I don't think it is appropriate for China, and I think we're going to start to see some pretty obvious manifestations of it, not only in the infighting that was caused by Bo Xilai, China's most charismatic politician, who is now under house arrest. But I also think that we're seeing it because of their inability to deal with the economy, a state-led one, which is no longer appropriate. And we're seeing the inability of the party to mediate social discontent in society. So I think a lot of people, maybe even most people, maybe even almost everybody, understands in China that a one-party system is no longer appropriate for a modernizing society. And what replaces it, we don't know. I mean, if you look out long enough, if you look out decades and centuries, you're going to say that the Chinese people will want the same things we do, which
Sure.
is more say in their lives and a freer economy. But in the interim, you could have a country that is once again considered to be the sick man of Asia, as it once was called.
Okay. Wasn't China the last time there was revolution kind of inward-facing, turned away from the rest of the world?
Yes, that occurred, of course, after the founding of the People's Republic in 1949. You had what was then called the Bamboo Curtain, and you had a number of very unfortunate incidences and campaigns, the anti-rightist movement, the Great Leap Forward, and the Cultural Revolution. And it wasn't until Deng Xiaoping at the end of the 1970s that China sort of adopted a better course, at least with regard to its economy.
Chinese politics making the news these days. In recent news, a Chinese suicide bomber, they're calling her, killing herself and 3 bystanders in a protest over the forced seizure of her home. Pretty obvious the party cannot control its own people, and a lot of folks are wondering if a country like that works that way at home, can it possibly be a good trade partner with other nations?
Well, it can't be a good trade partner because it doesn't adhere to its promises. And China's gotten worse recently, not better. It's trying to use its trade leverage as a geopolitical tool. It's doing that against the Philippines right now with regard to their tense standoff in the South China Sea. It did it against the Japanese in their standoff over the Senkaku Islands. And so essentially what you've got right now is a country that is just not prepared to be a responsible member of the international community, whether you're talking about geopolitical issues, human rights, or even trade.
We're talking to Gordon Chang on This Week in Money. Gordon, you also write about nuclear proliferation. Like most sane people, you're against it. What is your take on this? Here's news that China is pressuring North Korea to scrap plans for a third nuclear test. What's behind that, you think?
Yes, but China is not willing to do what is necessary to actually stop North Korea. As we saw on April 15th at that parade in Pyongyang, the missile launchers that the North Koreans showed off are Chinese versions. Either the Chinese sold them or they sold the designs for those missile launchers, may have even sold the accompanying missiles. So right now, we've got a country that is selling ballistic missiles to Iran in all probability. It is definitely transferring nuclear weapons technology to the Iranians and certainly supporting both North Korea and Iran in many different ways. China has been the source of a lot of nuclear technology, weapons technology in Pakistan, Iran, Syria, North Korea. And so we're dealing with a country that has really been the cause of the global problems. And unfortunately, we in the West are not willing to confront that fact in public. And that means that the Chinese are able to continue to create mischief around the world when it comes to nuclear weapons and missiles.
Gordon G. Chang is a columnist at Forbes.com and TheDaily.com. He blogs at WorldAffairsJournal.org. You can follow him on Twitter at Gordon G. Chang. Gordon, good to talk today.
Thank you very much.
After the break, David Skarika on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
David Skarika is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find Dave on the internet at addictedtoprofits.net. Hey, Dave, welcome back to This Week in Money.
Thanks for having me.
Markets have just closed. The Dow on track to suffer its 12th loss in 13 sessions, the worst weekly point loss since November. The only bright spot, Facebook in the most heavily traded IPO ever. Dave, listen to these numbers. More than 375 million Facebook shares changing hands in the first 3 hours, 100 million in just the first 3 minutes. That's exciting, I guess, if you're buying Facebook. I
didn't really go anywhere. I guess I'm not that excited because I wouldn't be buying it. The market cap is $100 billion. By comparison, Disney, which is a media company which has been around a lot longer and has a lot more in terms of profit and revenues, has a market cap of about $80 billion.
Okay.
So I personally think that it's like a mini bubble, the whole social media thing, and I'm not a tech expert by any means, so take this with a grain of salt, but I really don't see how you can make money out of these business models in the long run. I think it's kind of it's much more similar to stocks like the Globe.com or AOL or companies that like had these large followings but couldn't translate that into profits. Then it's like eBay or Amazon or internet-based companies which are commercially orientated organizations. So I personally think that, even because there's a big frenzy around it, maybe in the short term it can kind of live off that momentum and go higher.
Yeah.
But I think ultimately, actually, Facebook is going to end up being much more similar to the dot bombs than it is to a Google or an Apple or an Amazon.
Once the IPO excitement starts to fade, we realize that this is, after all, a public company, and people start looking a whole lot more closely at things like revenue from advertising and expenses.
Yeah, I think that's the whole thing. And if you actually look inside some of the Facebook numbers, and I haven't really wanted to follow it that closely because I think it's just a big overhype. But I did look at some of their numbers, that a lot of their quarter-over-quarter numbers, like from the fourth quarter last year to the first quarter this year, in terms of advertising revenues and the like, have actually seen decreases, which is really bad because they're really in that initial stage where they're supposed to be seeing explosive growth. Like they're supposed to be seeing 20%, quarter-over-quarter growth or 50% year-over-year. And if you're already seeing something stagnate, and this was kind of exemplified by GM pulling out on some advertising from them, I think they're just going to have a difficult time, making some of these, making this into a bottom line type business. And I think one of the problems is it's just your frame of mind when you go on to a lot of these social media sites. When you go to Facebook, you're there to maybe talk to a friend or, people, whatever, they post pictures of their dogs, like they're not there to go and buy something. But when I go to Amazon, it's like, especially I live on an island that doesn't have a Sears or a Walmart, so I order a lot of my stuff online. And when I go to Amazon, it's like, I need, pictures for my walls. I need new furniture. I need whatever, and I can find it all on Amazon and order it and plunk down to whatever, a few hundred, a few $1,000s. Where on Facebook, I'm not in that mindset.
Okay.
And if anything, I don't want to be barraged by advertising and the whatnot.
Sure. We're talking to Dave Skarika here on This Week in Money. Boy, when you look back at internet IPOs in the last year or so, here's a couple of examples. Groupon, Zynga, LinkedIn, the average return of that group over the year following the IPO, minus 54%. So it looks a little discouraging if you're putting money down today for Facebook, doesn't it?
Yeah, I think LinkedIn was the only one that's actually done half decently, and the other two have been very, very, miserable. So, yeah, I think that's kind of a big warning sign. I think that, again, see, a bubble, people use that bubble, I think the bubble word a little too loosely now, because what's happened is no one talked about bubbles until the 1990s because we hadn't seen a real financial bubble in so long. But a financial bubble is something that basically influences people's behavior because it's so large. Like the housing bubble caused people to borrow more on their homes and make it spend more. And the dot-com bubble, created all this artificial wealth. And I think that when you get these mini bubbles, this is not really, changing the behavioral patterns of people, but it's kind of a mini irrational exuberance and something that people really want to catch on to. And I think it's overdone the impact that these companies can have financially on financial markets. So I just think that the Facebook is probably the final nail in the coffin of these kind of like social media sites coming public and the whatnot. And I think, and we're going to get to this later on in the interview, ultimately this will actually help gold and precious metals because it's going to be one less sector which is battling for the money among investors because it's going to go by the wayside and everybody is going to forget about these companies in a year or two.
Dave, once the Facebook hysteria dies down, we, of course, are back to business as usual. And that is worrying about the Euro, the G8 meeting today at the top of the agenda. Greece may be exiting the Eurozone, and Spain and Italy. They're also on shaky ground, and that's the real world, right?
Well, see, this is where I'm really interested in right now. Even more so than what we're going to talk about again later, like the precious metal stocks and the whatnot. I actually think, and a lot of people are probably going to laugh at this when I say this, that one of the best trading opportunities you're going to see in years coming up is actually going long a lot of Greek equities, probably after if they exit and during a default and hyperinflation. Because if you look at the history of default, and I'm putting together a special presentation about this for my subscribers.
Okay.
When you buy a default, not only do you get great returns in the next year or two following that default, they're like phenomenal returns. The Greece stock market, as by gauge gouged by the Dow Jones Greece Index, peaked at around 750 in the year 2000 and now trades at 36. So those are the kind of collapses that actually give you great buying opportunities, and you're buying what John Templeton would call maximum pessimism. So I actually am going to be watching Greece very closely, and I'm not one who really thinks the Greece thing is going to turn into a contagion. I think that's They've already written off a lot of that debt on the books. I think that if Greece is kicked out, they are going to monetize Spanish and Italian debt like crazy so it doesn't spread to those nations. And Greece is very, very unique in the makeup of the debt and the severity of the debt crisis. And I think that actually going long certain Greek equities in the course of a default, and again, if you look at Argentina in 2001, if you look at Russia in 1998, if you had gone long during those defaults, those are essentially the best performing markets in the world in the 5 years that followed. So I think there's a great opportunity here. While everyone's looking at this Facebook thing, which is some overvalued company, which in my opinion is no way going to live up to its current market cap, people are ignoring a lot of companies in Greece which are trading at 3 or 4 times earnings and yielding almost in the double digits because of this default that is coming.
More with David Skarika next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're talking to David Skarika from addictedtoprofits.net here on This Week in Money. All of this turmoil, of course, Dave, good news for gold. It's up for a second day this week, following the 10-month lows it hit earlier this week. Nice to see gold doing something, and that is surprising considering the strength in the U.S. dollar.
Well, I don't think the U.S. dollar strength, at some point, it has more to do with euro weakness. And if you kind of look at, like, for example, the correction last year that we saw in European shares, and again, when we were getting a bit of wave of the European crisis, which seems to happen about once a year now, gold rallied with the U.S. dollar last summer because what happens is people begin to worry about, the solvency of European companies, European banks and European countries. So what happens is they move into precious metals as kind of a protection trade. So what we've seen in the last few weeks has been frustrating because you see people getting out of the liquidity trade. You see people getting out of risk assets, out of kind of the QE trades, the inflation trades, and gold suffered, and the gold stocks especially suffered from that in the last few weeks. But now you're kind of seeing that turn into somewhat of a fear trade. That now people say, well, okay, maybe we're not into gold because, of more money printing and more inflation, but maybe we're out of gold because of, or maybe we're going to get into gold because now we're worried about the solvency of a lot of these banks and European sovereign nations, So I think that is what you're going to see in gold in the coming months, that we're really oversold, we're due for a rally, and the fear of lack of liquidity, which has driven the sell-off, is going to turn into just out-and-out fear, which is going to drive a rally.
Dave, speaking of rallies, some good news out of the TSX in Toronto this week. Gold miners and energy companies continuing to climb. But listen to this. The TSX venture about the same level it was in mid-2010. And that was when silver was $17 an ounce and gold was $1,200. So the miners still have a long way to go. Well,
yeah. And again, like the HUI index, which is the AMEX Gold Bugs index, which is an index of large cap gold stocks, is right about 400, which is actually where it was in 2006 when gold was under 700 an ounce. So what we've seen is this valuation contraction where, some gold stocks have diluted, to issue shares to raise money for projects. Some of these projects have run over budget and maybe higher cost than expected. But on the whole, where it's 5 or 6 years ago, a lot of these gold stocks are maybe trading at 30 or 40 times earnings. Now we have a lot of the large cap gold stocks trading at under 10 times earnings. We have junior stocks trading at, instead of trading at $300 per ounce in the ground, they're trading at $100 or $50 an ounce in the ground. So this is another great opportunity where you're getting these cheap assets right now because of whatever, fears of liquidity, because of, maybe momentum players just shorting gold stocks because that's worked in the last half a year. So we're getting this great opportunity. And if you talked about compared to the price of gold, where the CDNX was. If you actually take the CDNX or the HUI index compare them to the price of gold or certain gold valuations of these companies compared to the price of gold, in a lot of ways, even though the nominal prices were lower in 2008, compared to the price of gold, a lot of these gold equities are cheaper than 2008 when compared to $1,600 gold. So we're getting this like fantastic opportunity, unless the stocks are completely way ahead and are predicting that gold is going back to 1,000, which a lot of these stocks are priced for. You're getting a chance to buy these stocks at pennies on the dollar. And I never thought you would see that in the secular bull market. I know we had the crash in 2008, but I never thought you would see a sector in a long-term bull market like precious metals and the precious metal stocks and us get back to these valuations for whatever reason. And I think right now, if you're underexposed to that sector, it probably over the next year or so is a great time to get in. And, there's this thing called the 4-year presidential cycle, which says that in the second year of the presidency, stocks usually bottom. If you go back to 1960, you'll see about 80 to 90% of the time they have in the second year of the presidency. I now think there's a 4-year cycle in these gold equities that since 2000, starting in 2000, then 2004, 2008, now 2012, there were very, very important lows in the gold and precious metal stocks every fourth year of this bull market. And those were followed by very strong 2 to 3 year rallies in the precious metal stocks. So we should bottom sometime this year and then see a very strong rally into 2014, 2015.
Dave, we are looking at some crazy times over the summertime with markets and metals. For folks who are interested in your newsletter and finding out a little bit more about it, how can we get involved?
Yeah, go to addictedtoprofits.net. And actually, this is a great time to sign up. I have a free newsletter on the site where I post interviews like these and basic information. But like I said, I'm going to be posting this next week. I'm going to be posting a video on maximum pessimism and on past defaults and past crises to show you how to make money out of these crises. And then if you're interested in subscribing for my paying subscribers, I'm going to be posting videos on actual ideas that if we get this great default, actual investment ideas, which I think would do really well in the coming years in the event of such an occurrence.
Sounds like a great idea. David Skarika, author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find Dave online at addictedtoprofits.net. Hey, Dave, it's always good to talk. Thank you, sir.
Thanks for having me.
Thanks to our guests, Jack Crooks, Gordon Chang, and David Skarika. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.